We're starting off with a look at the global market, where tech stocks are making headlines. The Nasdaq has been on a roller coaster ride lately, with some of the biggest names in tech experiencing significant swings in their stock prices. Apple, for example, has seen its stock drop by over 6% in recent days, while Micron Technology has surged by over 15%. These fluctuations are a reminder of the volatility that can come with investing in the tech sector. But it's not all about tech. We're also seeing signs of resilience in the labor market, with U.S. weekly jobless claims dropping more than expected. The number of Americans filing for unemployment benefits fell to 215,000 last week, beating economists' forecasts of 225,000. This suggests that the labor market is holding strong, despite concerns about a potential recession. Meanwhile, in other news, Ling Yi, a Chinese tech company, has announced plans to expand its operations into the U.S. market. The move is seen as a significant development in the ongoing trade tensions between the U.S. and China. We'll be keeping a close eye on this story and bringing you updates as more information becomes available. And finally, we have some news from the world of finance, where investors are increasingly turning to artificial intelligence to inform their investment decisions. This trend is expected to continue, with many experts predicting that AI will play a major role in shaping the future of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating discussion about retirement planning and the challenges that come with it. Sounds like a dream, right? But let's take a closer look. Our story reveals that renting might be a more feasible option than buying, considering the steep carrying costs associated with owning a property in Key West. We're talking about wind insurance, flood policies, and standard HO3 coverage that can run up to $15,000 annually. Add to that property taxes, condo association fees, and electricity bills for AC, and you start to see why renting might be the way to go. Now, let's talk numbers. Our retiree needs to cover roughly $90,000 annually, with Social Security providing around $16,800. That leaves a shortfall of about $73,000, which translates to a withdrawal rate of 4.6% on their $1.6 million portfolio. However, experts agree that a more sustainable rate for early retirement is around 3.5%, which would produce approximately $56,000 annually. So, what can our retiree do to close the gap? They could consider moving slightly off-island, delaying Social Security claims, or arriving with a larger nest egg of $1.9 to $2.0 million. But here's the thing. Insurance premiums in Key West are compounding at an alarming rate, with some policies rising by double digits annually. This can lead to a silent budget killer, where a $12,000 insurance bill becomes over $120,000 annually by the time our retiree reaches their 90s. To make this scenario work, it's essential to prioritize tax-efficient portfolio withdrawals, sequencing Roth and taxable account bases to preserve ACA subsidies. By doing so, our retiree can keep their modified AGI low and avoid losing out on $6,000 to $10,000 in annual subsidies. In conclusion, retiring to Key West at 62 with $1.6 million requires careful planning, a sustainable withdrawal rate, and a deep understanding of the local insurance landscape. While it is possible to make this scenario work, it is crucial to be aware of the potential pitfalls and plan accordingly. Welcome back to the Riskwiser Zone. As we wrap up today's episode, I'd like to shift our focus to the world of stocks and investments. We've been exploring various topics related to risk management, but it's essential to acknowledge the intricacies of the stock market and how they impact our financial decisions. Recently, an article caught my attention discussing the valuation of Broadcom, a prominent player in the tech industry. The piece highlighted how the company's current price might be misleading, as it implies a much lower multiple when considering the earnings expected in 2028. This forward discount is only as real as the growth that creates it, and investors need to carefully evaluate the plausibility of the forecast. The consensus estimates assume Broadcom's revenue will grow about 48.1% annually for the next 2 years, which is a significant acceleration from the 32.3% revenue growth the company delivered over the last 12 months. While this leap may seem ambitious, the company's recent quarterly performance and management's guidance suggest that this growth might be underway. The driving force behind this growth is the increasing demand for AI semiconductor revenue, which is expected to accelerate to $16 billion, up over 200% year-on-year. With bookings for AI chips recently coming in at over $30 billion against $10.8 billion shipped, the company's visibility runs all the way to 2028. It's crucial for investors to understand that the reward is not the discount itself, but rather the potential price appreciation that comes with it. If the share price never moves, by 2028, you would simply own the stock at 15.1 times earnings. The actual gain comes from the market continuing to pay a richer multiple as those earnings arrive. As we navigate the complex world of investments, it's essential to remain cautious and informed. The story of Broadcom serves as a reminder that growth and valuation are intricately linked, and investors must carefully evaluate the numbers behind the narrative. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.